Cooper? No, not that Bradley Cooper. I'm Bradley Cooper, the CPA. I'd like to talk to you a little bit today about LLCs taxed as partnerships. First of all, we need to understand what an LLC is. An LLC is a legal entity, but all the states of the Union have these LLCs. However, an LLC is taxed by the Internal Revenue Service. The Internal Revenue Service only has three ways that it can tax businesses in this country: sole proprietors, partnerships, and corporations. So if you want to have an LLC, you must choose which way that you can tax that LLC, and the IRS doesn't care which way you choose. However, if you're a single member LLC, you cannot file as a partnership. A partnership is two or more individuals engaged in an activity for profit. If you're a single member LLC, you cannot file as a partnership. But you can file as a partnership or corporation if you have two or more members. There are usually two different kinds of partnerships. There's a general partnership and a limited partnership. A general partnership is where the partners share duties and responsibilities and obligations. They're each responsible for some aspect of the business. A limited partnership has a general partner and limited partners. The general partner in that situation is the person that is responsible for the day-to-day operations, the management of the company, and the operations. The limited partners are usually just investors. They usually are investing so that they will receive a share of the profits. Many people ask, who can be a partner in a partnership? Just about anybody can be a partner in a partnership. Individuals, corporations, other partnerships, estates, trusts. There really is no limit on who could be a partner. Many people ask me about husbands and wives. If they are partners in a business, are they treated as a partnership, and must they file a partnership tax return? The answer is yes. If they are a partnership, even though they're husband and wife, they are required to file a partnership tax return. Now, there are some exceptions to that. So if you think that you qualify for an exception, so if you think you would like to get out of filing the partnership tax return, look and see what some of those exceptions are. There are many advantages to filing as a partnership. The biggest advantage, in my opinion, to filing as a partnership is that partnerships allow you to allocate profits. Let me give you an example. Let's say that partner A, B, and C decide to go into business to build houses. Partner A, B, and C decide that they want to build house number one and that they're going to split the profits equally on house number one. After house number one is completed, partner C decides that they do not want to be a part of the next project. Maybe they're too busy with other things at that time and they can't devote enough time to that project, so they just bow out. So partner A and B split profits equally among themselves on that project. And then partner C decides that they do want to come in on that project. So therefore, at the end of the year, when we add up the profits for all three projects, then we will allocate the profits based on each project, not based on the income at the end of the year. So therefore, these partnerships are very flexible as to how they are going to allocate profits. They could also allocate profits one way and allocate losses another way. So a lot of flexibility when it comes to allocating profits and losses and equity when it comes to partnerships. Another advantage to partnerships is the term guaranteed payments. Now, in the corporate world, what we would look at is if an owner worked in the company would have to pay them a wage. Now, what that entails is the company has to deduct taxes from those wages. They have to pay those taxes into the IRS either monthly or quarterly. They have to file tax returns with the Internal Revenue Service every quarter and annually, and they have to file W-2s for that employee as well. If you're a partnership, you will not be an employee of the partnership. You're still a partner. All we're doing is allocating funds to you as a wage, and we call that a guaranteed payment. Now those guaranteed payments are going to be given to you not on Form W-2 like a wage is going to be given to you, but it's on Form K-1. And those guaranteed payments are taxed for income tax purposes and for Social Security tax purposes. Some of the disadvantages of a partnership is that the profit of the partnership is all subject to income tax and Social Security tax. Now there are two different kinds of activities that a partnership can be involved in when it comes to Social Security tax. One is an operations activity, meaning if it performs services for someone such as an accountant, an attorney, a bricklayer, a painter, a plumber, any of those kinds of folks that perform services for others, or if they are in retail or wholesale sales and they are selling things. The profits for those companies are all subject to Social Security tax. There are some activities that are not subject to Social Security tax, and that's usually in the area of rental real estate. So if the partnership rents real estate, then the income generated from those activities are subject to income tax but not Social Security tax. Another disadvantage of a partnership is the complexity of the tax preparation. Partnership taxation is very complex. There are a lot of laws that deal with partnerships and many exceptions to how things are done. If you don't understand these concepts, please find someone who does. At the end of this segment, you should know enough about partnership taxation to question your tax preparer to make sure that they understand at least as much as what you understand. If they don't, please find someone else. We prepare partnership tax returns for many people located throughout the United States. If you need some help and would like us to assist you in the preparation of those tax returns, please let us know and we'd be glad to do so. One of the other disadvantages of a partnership is that losses are limited to basis. So let me explain basis so that you understand what that means. Basis starts with monies that you contribute to the partnership. It is reduced by monies that the partnership gives to you that are classified as distributions. It increases by profits that the partnership generates and reduces by losses that the partnership incurs. Let me give you an example. Let's say that in year one you contribute $10,000 to the partnership, and during the year the partnership distributes $2,000 to you. You now have a basis of $8,000. If the partnership loses $12,000, then you have a basis of negative $4,000. Let me explain to you another way of saying that. When you receive your information from the partnership that indicates your share of the losses were $12,000, remember your losses are limited to the basis, and your basis is only $8,000. Therefore, you can deduct $8,000 on your personal tax return. The other $4,000 is considered a suspended loss, and that will be carried over to next year. So let me tell you how that is deducted next year. Again, we now have a basis of 0 and suspended losses of $4,000. If next year the partnership generates $5,000 in profit, you will put on your return $5,000 in income less $4,000 in suspended losses equal $1,000 that you have to pay income tax on. Those suspended losses are carried forward from year to year until they're used up or until you dispose of your partnership interest, at which time all of those suspended losses are deductible. Partnerships are pass-through entities. What that means is that the partnership does not pay income tax on the profits and does not deduct the losses that are generated by the partnership. However, those incomes and losses are passed through to the owners, to the partners of this company. You will receive a K-1 that tells you your allocable share of the income and the losses that you must put on your tax return. The purpose of this K-1 is twofold. One is to let the Internal Revenue Service know who is going to pay tax on this income or deduct these losses on their personal tax return. Second is to let you know how much of the income or losses that are going to be deducted on your return. The K-1 will not calculate anything to do with basis limitations. You are required to calculate that on your own. One nice thing about a partnership is this. If you incur any business expenses that you pay from your personal funds and not deducted on that partnership return, then you can deduct those expenses against your partnership income on your personal tax return. One last point that I want to make is this. Many clients have asked me about distributions. Are distributions from a partnership taxable? In general, the answer is no, they're not. Let me explain why I say that. If in year one, the partnership generated $10,000 in income, they put that $10,000 on a K-1 and you have put that $10,000 on your personal return. However, they gave you $8,000 as a distribution for that year. Again, you pay taxes on the profit and not the distribution. In year two, let's say they generated $10,000 in income again. They put it on a K-1, you put it on your tax return and pay taxes on it. But they also gave you $11,000 during the year as a distribution. What we're going to consider that as is $2,000 was last year's profit that they did not distribute to you, and $9,000 is this year's profit that they are distributing to you. So as you can see, you are paying taxes on the income that is generated by the partnership and not the distribution that the partnership gives to you. I hope this gives you some indication of some of the advantages and disadvantages of a partnership. If you have a question concerning partnership taxation I wasn't able to answer, please email me at bradley@W.B.CooperCPA.com.